you a range of oscillators and how they can be used for determining whether a market has gone too far, too fast, and may be due for a pullback. And it could be quite good for setting up a counter trend trade. So first things first, indicators, the oscillator is an indicator which swings or oscillates between extreme high and low levels. In other words, the market moves from overbought to oversold, a bit like a pendulum swings from left to right, and used to gauge whether a price move has become overextended. So with oscillators, you can detect whether there is a loss of momentum, which typically leads the price reversal. So unlike with trend following tools, for example, moving averages, channel breakouts, that kind of thing, they tell you which way the market has been going and which way the market is trending, whereas oscillators are kind of an early warning signal which gives you an indication as to whether the market may be apt for a reversal. So they will give you a much earlier warning signal for a change in trend. So before the price changes trend, typically you will see some kind of loss of momentum before we get the trend change. So trends typically, they fall of their own weight. So imagine a situation where when one throws a ball in the air, and as it gets higher and higher, the speed of ascent starts to decline. So that's the kind of loss of momentum. You know that gravity is going to bring it down, and eventually, once it reaches its peak, it starts to fall. So that's the kind of concept that we're using when we look at market momentum and use oscillators to gauge it. So with oscillators, what you do with any other indicator, actually, or most indicators, you plot them below the price chart. So typically what you'll see is a bar chart or a candlestick chart, and below it you'll see an oscillator which gives you the overbought, oversold kind of readings. Now, as with most other indicators, they are supporting tools, so they're kind of subordinated. The most important thing, obviously, is the price chart, the direction of the trend, the dynamics of some of the bars and maybe the candlesticks. So they're kind of a supporting tool. So one shouldn't really trade on indicators alone. So let's take a look at how some of these oscillators move. So just the typical kind of theory of the oscillator, markets will typically go between overbought and oversold. So you'll get this kind of swing high, swing low, swing high, swing low, a kind of sine wave situation where the market just gets overextended, tops out, and then starts to head lower, and so on and so forth. So the main uses of oscillators are to identify extreme zones where the market is likely to reverse. In other words, overbought and oversold areas. And also to detect what is known as divergence with the price move. Because what happens often is when a price is trending higher, you'll typically get pushes to new highs for the trend matched by new highs for the oscillator. But at a certain point, you'll get new highs for the trend, which is not matched by the price oscillator. And that's known as divergence. And that can give you kind of an early warning signal that the trend is likely to reverse and perhaps to take some profits or maybe to go counter trend. Another use of an oscillator can be to identify the trend. It can actually be used as a trend following tool. For example, using the zero line of an oscillator or a midpoint of the band that you're looking at. Now, oscillators tend to break down into two types. Some have fixed limits, for example, between 0 and 100. And these would be, for example, stochastics and relative strength index, RSI, whereas others don't have limits, for example, momentum and rate of change. They will just continue to go higher with the price and they'll top out on their own. There's no artificial ceiling to those indicators. So for those kind of indicators, the best thing to do for overbought and oversold is to use visual inspection. And I'll show you a number of examples where one could use visual inspection on these unlimited oscillators. So let's see some examples of oscillators in action. Okay, first one is a chart of gold futures, COMEX futures. And what you can see there is a daily chart, an uptrend, and below the chart is an RSI oscillator, a 9-period RSI oscillator. Now, the default settings are usually 30 is the oversold boundary, and 70 is the overbought barrier. So when the market is in a range, the oscillator typically matches the highs and lows in the price. But when it's in a trend, you'll get a situation where the market pushes into overbought territory, corrects back, and the oscillator bases out somewhere above the oversold region. And you can see clues on the oscillator as to whether you're in a bull or a bear situation as to where it bases and tops out. Here's another example here of the RSI. This is with a euro-dollar chart on a 30-minute time frame. And you can see, for the most part, this chart went sideways, and the RSI oversold and overbought zones pick out some important tops on this particular chart. This chart looks like it's good for intraday traders. So an intraday chart with an oscillator to go with it can help identify turning points for some of these markets intraday. You notice that a lot of these highs and lows in the oscillator with the price have been ringed, just to show you that as the market pushes higher, the oscillator makes a new high above overbought, and then the price tops out, and then the oscillator tops out, and that can give you a sell signal for the next few bars to the downside. Another example, 30-minute Aussie dollar, Aussie US. A similar kind of thing with the last example. The market is effectively moving sideways with a little bit of a trend to the downside at the end. Here I've plotted two oscillators, the RSI and the stochastic, just to give you an example, an idea that how they kind of they move, how similar they tend to pick out peaks and troughs roughly around the same time. There isn't a whole lot of difference between the indicators. So you can get to a situation where if you're plotting too many indicators, there's a certain redundancy of using many indicators, because essentially they're telling you the same kind of information. This one's a much longer term time frame chart. This is the dollar against the Canadian dollar, US dollar CAD, loonie. And you can see it's plotted with the stochastic oscillator, 14 period, 14 week in this case. The stochastic has slightly wider zone, a neutral zone between overbought and oversold, and that's 20 and 80. There are the default settings for the oscillator, the stochastic oscillator. So when stochastics goes above 80, then the market is said to be overbought, and you're looking for some kind of turning point. And similarly, when you get below 20, you have an oversold situation, and you're looking for a turning point to the downside. Again, I've ringed a lot of the turning points on this particular chart to show you how they coincide with peaks and troughs in the oscillator itself. So in this case here, first of all, the market breaks down, market goes oversold, stochastic below 20, the market bases out, starts to move higher, the oscillator crosses back above 20. Also, another thing with some of these oscillators is you will often get a slower average line plotted, so that you're looking for crossovers between the line itself and the oscillator and the average of the oscillator, and they can give you signals which I'll come to a bit later on. So yeah, you have the market breaking down, basing out, starting to move higher from the oversold region. The market goes up, stochastics enters the overbought region, tops out, market trends lower, big swing down. And then you've got a number of peaks and troughs here, which could have given you a good opportunity for, in this case, a multi-week swing trade. Okay, so oscillators, like all other technical indicators, they're not 100% foolproof. There will be, all of them have their own advantages and disadvantages and limitations in this case. So oscillators, they work best in non-trending and range-bound markets, as I've alluded to earlier on. So when the market is in a kind of a chop phase, it's swinging between overbought, oversold, the oscillator tends to coincide with market peaks and market troughs, and therefore they have some value for the future. Whereas if the market is in a trending phase, the oscillator will be getting you, making you kind of fade the trend. When the market goes overbought, you're looking to sell it, but the market wants to continue higher. So when the market is trending, oscillators are not particularly doing a great job of helping you make money by going counter trend. So in ranges, they are very good indicators of what is too high and what is too low. And that's really what you're looking for. If you're a mean reversion trader, if you like to sell something because it's expensive and it's gone up quickly, then the oscillator is kind of a very good tool for you. But particularly when the market is in a chop phase. So as I say, when the market's in a trend phase, you tend to find that they perform poorly because you're fighting against the trend. Because what happens is when the market's in a strong trend is the market stays overbought for long periods of time. So you'll find yourself kind of fading the market, shorting the market if it's going up, and the market continues to rise. And similarly, when the market is in a downtrend, if you're looking to buy an oversold oscillator, then you're going to lose money because the market continues to make lower lows. One thing I wanted to mention about oscillators is they do have value during trending phases, because obviously the market can be overbought and you can take profits on long positions, for example, in the bull market. But also, as I mentioned, there's a kind of a shift to the upside of the oscillator's range. So RSI, for example, its normal boundaries are 30 to 70, oversold, overbought. But during a bull trend, what you'll find is the market tops out at higher levels of RSI. So, for example, 80 and above. Whereas when the market comes down and corrects, you'll find the market is basing out not at or below 30, but maybe around 40 or 45. So oscillators do have value during trending phases as well. Okay, so just to give you a bit of a graphical illustration of the limitations of oscillators. So this is what a fixed limit oscillator looks like. Now we're talking about things like stochastics and RSI, where they're plotted literally between 0 and 100. You can't go above 100 and you can't go below 0 on these oscillators. So what you'll find is in a downtrend, the price in green here is trending lower, making lower highs and lower lows. And the oscillator goes along with the price, but when the oscillator gets towards that 0 line, obviously it can't go any further than 0. So the price continues lower and the oscillator is not making moves to lower lows. So there's a kind of artificial barrier to the oscillator. Just to interrupt, just seeing a question here. What indicators do I rely on mainly in a trending market? I like moving averages. Obviously, they're quite simple. They lag the market and they give you good indications as to where to look for areas to buy into after a pullback. With regards to trend following, I like the idea of using Donchian channels, in other words, highest high, lowest low for the last N bars, that kind of thing. Very simple indicators. In fact, I covered them last week. I'm sure I'll be covering them again at some future date. Yeah, for trend following, I think simple things like moving averages and channel breakouts are quite good. Okay, so back to oscillators. So with the no limit type oscillator, for example, rate of change or momentum, they tend to oscillate above and below 0, and they will obviously go negative. So in this case, what you've got is the price is trending lower, making lower highs and lower lows, and the oscillator will go with it. So there's no kind of artificial basing out of the oscillator, which creates a kind of a false or fake divergence. Okay, so I'm just going to talk specifically about some of the indicators. Obviously, there's so many that you can use, so it's quite exhaustive. So I think what I'll do is I'll just cover a few of the more important ones, because they all essentially do the same kind of thing, but obviously they have their own twists. So first thing, pure and simple, is the momentum oscillator. So the momentum oscillator just a simple measure of the velocity of price changes. It's really just a case of taking the close of the current bar and subtracting the close of n bars ago. So if you're going to measure a 10-day momentum, it's just the close of today minus the close of 10 days ago. And momentum is plotted around a zero line. So again, there's no artificial upper or lower boundaries. And the overbought and oversold areas, they are observed obviously by visual inspection. So you can't say, well, we're above a certain level, it's overbought. It's really a case of looking at historical charts and figuring out for the market that you're looking at and for the time frame you're looking at what has worked in the past. So again, you're looking for divergences with the price for potential turning points using Momentum Oscillator. As with most indicators, the shorter length that you use, the more sensitive the indicator will be. So there'll be a lot more oscillations, a lot more signals if you're using them as a timing mechanism. And as I mentioned before, crossing above or below the zero line can be used as a trend indication. Okay, so just to show you a few examples of the Momentum Oscillator with a number of charts, just to show you how it can be applied. This is a chart of dollar yen, a daily chart of dollar yen. The market, for the most part of this chart, has been in a range, ideal for momentum oscillator trading. And what you can see with this momentum oscillator, this is a 20 period, the 20-day momentum oscillator for dollar yen. What I've done is I've drawn lines pretty much above the where the peaks of the oscillator come in at +5 on dollar yen, and also just for translation at -5 dollar yen. So you can see that as the price moves higher, the 20-day momentum oscillator, as it gets close to this +5 level or close to this -5 level, we're getting close to a potential turning point if the range is to continue. So don't forget, I mentioned that oscillators are only good during trading ranges. So there's a certain assumption that as long as this trading range is going to hold, it's going to go sideways, back and forth, then the oscillator can provide a very good indication of where one should look to buy and where one should look to sell. Okay, another example here. This is dollar CAD. For the most part, in a sideways market, so oscillators do well in sideways markets. And then in Q1 this year, we got a big move higher on dollar CAD. So obviously the oscillator shot up and became even more overbought. So you can see with dollar CAD in this case, what I've done is I've drawn lines around +200 pips, -200 pips, overbought, oversold. So again, the 20-day momentum oscillator, as with the dollar yen example, the previous example, when we get towards that +200 or -200, excuse me, it gives us an area where we can look to take a mean reversion type trade. Obviously, things went out of the window when dollar Canada broke higher. It gapped up here. We saw this big explosion in volatility earlier this year, Corona related, obviously. And so the overbought region, obviously that kind of shifted, albeit temporarily. Once the bubble had burst on that particular move, by the way, dollar CAD, the rate of change, the momentum indicator came back into the prior range, and again it's based out on the way down at -200 pips. So it's interesting to see that even after a trending phase, the market starts to settle down, and the prior range for rate of change is respected. Okay, this is a chart of cable, sterling dollar, a weekly chart. For the most part, this market has been trending lower, but a long sideways range since the back end of 2016. I've plotted the same indicator, the 20-period momentum, and with cable, we have typically +10 big figures and it looks like close to 12 big figures on the downside. Obviously, there's a bit of a downside bias because the market has been in a bit of a downtrend. So again, there is this kind of shift in the oscillator readings of overbought and oversold when there's a trend phase. So you need to expect the market's oversold levels to be a little bit lower than normal when you see during a sideways phase. But for the most part, this kind of plus 10 big figures, minus 10 to 12 big figures appears to be a good area to look for cable to form some kind of reversal. Okay, squeezing up the time frames. This is euro dollar, an hourly chart, 60-minute chart. This one kind of a gradual trend lower, but quite wild oscillations within the trend. So opportunities to use oscillators to make money for mean reversion trades. Looks like on this one, plus 80 pips and minus 80 pips has been a good indicator for overbought and oversold. If you're a scalper or a day trader, 80 pips over this time frame is quite a good indication to use. Okay, so that's momentum. I'm going to move on now to rate of change, another popular one that that technicians like to use. So rate of change is a little similar to momentum in that it measures the velocity of price, but in this case, it's measured in percent. So the rate of change is simply the percentage change in the price compared to the price so many bars ago. So the 20-week rate of change is simply comparing the closing price to the closing price 20 weeks ago. Plotted around a zero line. Again, as with momentum, there's no artificial upper or lower boundaries. And we use visual inspection to ascertain the overbought and oversold zones. As with all oscillators, we're looking for momentum divergences for potential turning points. And the shorter length versions of the ROC are much more sensitive, producing a lot more oscillations. So typical kind of indicator theory there. Again, as with momentum, the crossing of the zero line can be used as a trend indicator. So a few examples of rate of change. First one is a daily chart of euro yen. For the most part, trending lower, although very big counter trend swings, which means that we can use oscillators to give us potential buy and sell signals, even though we're in a kind of a downtrend. So what you can see with this one is, for the most part, for quite a long period, 2 yen to the upside, 2 yen to the downside on the 14 period. In this case, the 14 period rate of change provide fairly good areas for overbought and oversold. This is euro against the Norwegian kroner. Daily chart. This is the 20 period rate of change. And we see quite wild oscillations. Markets trending a little bit higher, slightly shallow uptrend. But again, as with the previous example, lots of big counter trend swings. So in that respect, we can use oscillators. The pullbacks are not tiny and shallow. So we're not in a very strong trend. So oscillators do have some value during these kind of, even though they're trends, we still have kind of sideways movement within them. So in this case, we're talking about +3 and -3 on the rate of change. So you can see that when the market, in this case, is trending lower, it goes to around -3. That's the oversold region. Market bases out, swings higher for the next few months. Eventually breaks to marginally test the overbought region, tops out, comes back in, bases out around -3 there. A little bit of chop here, not really reaching the overbought and oversold regions. Then we get the break to the upside, and then the market stays overbought for a little bit, but doesn't stay too long above the overbought line, comes back down. This one, as we're kind of in a trending phase, we don't go as far down as the oversold region, up to new highs. Market makes a new high. We get this divergence here between the price, which is making a new high, and the oscillator, which is not making a new high. And that gives us the signal for a kind of an ABC correction, a corrective move against the trend here. Market pulls back, bases out just below the -3 level, and then up we go to retest the high, where it tops out just above the +3 level there. Okay, this is a kind of a weird example. It's using the 20-period rate of change again. This is dollar Mexico on a Mexican peso on a monthly chart. So what we've got obviously is a clearly defined uptrend. But as I say, when the market is in an uptrend, the oscillator, they shift to the overbought and oversold extremes shift to the upside. So in this case, what we've seen is when dollar Mexico goes to around what, -10 or so, that appears to be a good place to look for a base. And then when you see these big swings to the upside in the direction of the trend, once we get to around +40, that has been a bit of a ceiling for the market to take a breather. If not see a massive reversal, but certainly take a breather, time to take profits, maybe even go counter trend looking for some kind of mean reversion trade before you wait for the oscillator to base out. Okay, now on to quite a popular one, which is the RSI, the Relative Strength Index. So this is one of the most famous oscillators that people will use. I would say probably along with Stochastic, I'd say the two most important momentum oscillators that people like to use. So it was developed by J. Wells Wilder, and it's been used to measure the magnitude of recent price changes. So obviously looking for a kind of momentum indicator. Now this one, unlike the other two we looked at, has got these artificial ceilings and floors. So it's plotted between 0 and 100, with, as I say, 30 being the oversold level and 70 being the overbought level. The standard setting for RSI is the 14 period, and although the 9 period is also quite a common setting for RSI. So as I mentioned, when the market's in a trend, in an uptrend, the RSI often bases between 40 and 50 rather than going all the way down to say 30 and below. And similarly, when the market's in a downtrend, when the market bounces, the RSI often tops out between 50 and 60 and doesn't quite get up to 70, where one would normally expect the market to see the momentum top out. So divergence, as with most oscillators, is quite an important feature. So when the price makes a new high and RSI does not make a new high, it's a warning to the bulls. I'd say perhaps not quite as strong as the oscillators which don't have limits, but this is really how one would use RSI. Similarly, when the market makes a new low for a downtrend and the RSI does not, that's a warning to the bears that the decline may be losing momentum and could be due for a snapback. So let's see a few examples of price chart with RSI. First one, Euro-Yen daily. The market has been in a sideways range over this whole period. So for the most part, RSI is a good tool that one could use. So what we've got over this whole period is the market starts off initially, swings lower, corrects higher, swings lower again. The RSI, as it's in a downtrend, is making lows way below the 30 level, but turns higher here, snaps back through the 30, which could be used as a signal to buy. Market then trends higher for the next several bars. As the market swings higher here, goes into the overbought region, tops out, starts to trend lower. Good sell signal for a swing lower. Market breaks down below the oversold level, forms a bit of a base, and then starts to swing higher. The swing to the upside is reversed as the market just breaks above the overbought level, comes back. Now, as we're in a bit of a trending phase, as with back here, when the market pulls back, the RSI base is way above the 30 level. So that can give you a bit of a clue that the market is ready for another swing to the upside. So the market does swing to the upside, into the overbought region, tops out, and perhaps a good sell signal for a move lower. Now, this first swing lower, market gets to oversold, but this time doesn't see a whole lot of bounce to the upside. So we see just a bit of sideways action. So the market is kind of making lower lows, but just crawling low with the oscillator. So you're not really having a lot of joy if you're using the oscillator during this particular phase. But eventually we get this move to a new low, and the oscillator fails to make a new low there. So we have a divergence, and that gives you a bit of a clue the market wants to go higher. Okay, sterling dollar, cable, daily chart. What we've got here is the market starts off with a bit of a sell-off and then starts to trend higher into the end of the period we're looking at. So what we do is we start off, we're trending lower. RSI goes below 30 and bases out along with the price, snaps back above 30. Then that's the bottom for this particular swing. Market swings higher, corrects lower. RSI does not break below 30, typical trending action to the upside. And then the market swings to the upside like this, goes into overbought region. And then we get this situation where the market is swinging high, making higher highs and higher lows. But look at the divergence indicator. The RSI is not making new highs as the market pushes to new highs. So that's a bit of a warning. The market is ready to see some kind of a correction. So this is what happens. The market starts to swing lower along with the divergence indicator. Then we get to a stage where the market gets oversold there. Then the market pulls back, makes a new low, but then the RSI does not make a new low with the price. And that's a classic buy signal using RSI. And then the market swings higher, and that's the bottom of this particular swing. And then we start to trend higher. You can see here the first swing, market goes up above the overbought level, pulls back, finds a higher low in RSI around that kind of 30 to 40 region, and then swings high, makes new highs. Divergence here, swings lower, makes a new low for the trend. And this low coincides with an oversold reading, a bit like this one did back here. So a good place to buy. This one, euro dollar, a 2-hourly chart, just to show you that the thing works quite well on the shorter term time frames. So this one is trending lower, makes a swing low here, pulls back, makes a new low, but we don't get the new low for the oscillator. So we have the classic divergence, and that marks the low for this particular swing, and the market makes a new high for starts to swing higher. Market pulls back from the overbought region, and then the oscillator finds support again above 30 to tell you that the market is in a bullish environment, and then starts to swing higher. Makes a new high for the trend. It's overbought at this stage, but the market just goes a little bit sideways. You get all this divergence, and it's quite a big divergence here. The first one gave you the pullback to here, and then the second one gave you the big reversal in trend. So market swings lower, RSI goes to oversold, and then the market bounces and then gets stuck in this kind of bearish situation. But again, you've got this divergence here as the market goes to oversold, and that tells you the market is in a kind of is kind of supported for the time being. Okay, so now I'm going to move on to the stochastic oscillator. This one was developed by George Lane in the 1950s. And again, it's a momentum indicator, but what it does, it compares the closing price to the range for the look back period, the N-bar range. So again, it's got limits to the upside and the downside. It's plotted between 0 and 100. And what it is, it's the percentage of the N-bar range. So if we're looking at a 20-day oscillator and the oscillator reading is 80, then that tells you that the price is just closed at the 80% level of the 20-day range. So it's said to be overbought if it's 80 or higher, and below 20 or lower, it's said to be oversold. Now, the stochastic, a lot of people, what they do, because the stochastic is quite an erratic oscillator, it moves quite fast. what people do is they slow it down just by taking a moving average of the oscillator. So then what we've got is basically a 14-period oscillator, which is the standard setting, and you'll do a 3-period simple moving average of the oscillator. So that'll give you fast and slow stochastics. And then you can smooth it even further, doing a 3-period of the 3-period average. So you'll get fast and slow stochastics. So as with other oscillators, typical use, look for overbought and oversold extremes, and also divergence with the price. Also, the crossing of the stochastic with the moving average in an extreme zone can provide buy and sell signals. So for example, if the oscillator, the stochastic is below 20 and the indicator crosses above its moving average, then that can be seen as a buy signal. Also, people like to look at the simple crossing back above 20 or back below 80. Okay, so this is dollar yen daily, and this is giving you the 14-period slow stochastic of dollar yen. So for the most part, dollar yen has been in a bit of a range. Then we get these kind of violent oscillations in Q1 of this year. So as the market swings higher, it tends to stay in the overbought region when the market's in a trend. And when it pulls back in a trend, it bases out again above the oversold region. But when the market gets into a kind of a range situation, what you'll get is the market topping out close to, slightly above perhaps, the overbought level, and basing out pretty close to there or thereabouts to the oversold level. And that was the case here. So you can see some of the highs and lows in dollar yen have been accompanied by highs and lows in the oscillator. Euro dollar daily, this one pretty much a sideways market over the period, plotted with the 14-period stochastic below. The market initially breaks down, the oscillator goes below 20, we get this basing pattern, and that's the bottom of this particular cycle. The market goes up for the next several weeks. Market goes into overbought region, then we get this kind of divergence where the market is making new highs, but the oscillator doesn't really want to make new highs with the price. Tops out, and then we get this swing to the downside. Market becomes oversold, and then we get this it starts to base out. The stochastic crosses above the average, but the important thing is when the stochastic crosses above the 20 level, the oversold zone, and that gives you the buy signal for the move higher. Market breaks above, retests these highs, stochastic makes overbought, market makes a new high, oscillator makes a new high with it, but it's in the overbought zone. The stochastic crosses back under 80 and below the signal line, and down you go. Eventually the market comes back into the oversold zone, and again the market bases out. The stochastic flips back above 20 and it's above its average, and the market moves higher for the next several sessions. Okay, cable 30-minute chart, plotted with the 14-period slow stochastic. Again, a sideways market for the most time, so that the sideways market is good with the oscillators. Stochastic starts off, it's in overbought, crosses back below overbought. The stochastic is back below 80. The signal line is back below 80. They both move lower. Market becomes oversold. We get a reversal to the upside. Market swings higher for the next few hours. Tops out in overbought, and then swings lower. Then you get these kind of oscillations here between overbought and just below overbought and below oversold, and that's because the market is in a trending environment here. So you're getting the market stay oversold for certain periods, and when the market flips higher, doesn't quite make the typical overbought level as it did back here and here. So that gives you an indication you're in a trending environment. Here the market makes a swing low. We see a shallow correction. Stochastics, they break up, but they struggle to make it above 50, and then they cross to the downside. So bearish indications there. Okay, another one I'm going to talk about now is the MACD, Moving Average Convergence Divergence. And this one is a bit more, I wouldn't say complex, but it's got more going, it's got more to it. And I'll explain in a bit more detail. So MACD is a trend following momentum indicator, a bit of a mouthful because it does more than one thing. The MACD line is simply, it measures the relationship between two exponential moving averages. I covered those in the last presentation. If you need a bit more info on that thing, please give me a shout. And then an exponential moving average of the MACD line, which is called the signal line, is used to generate the buy and the sell signals. So when the MACD line crosses above or below the signal line, that gives you a buy or a sell signal. The histogram of the MACD is plotted to show, the histogram is plotted to show the difference between the MACD and the signal line. So you'll have, along with the MACD line and the signal line, you'll get a histogram which is plotted, which just shows you the difference between these two lines. Default setting for MACD, it uses the 12 and the 26 period exponential moving average, and the default setting of the signal line, the average of it, is 5 periods. So how do you use MACD? We're looking for the MACD line to cross above or below the signal line, as I mentioned. That gives you crossover signals. Also the divergence with the price at market turning points. And also you can use the MACD line when it crosses above and below 0. Okay, so a few examples of chart with MACD line. So what we've got here is cable in a trending phase this time. So it's in a pretty defined downtrend where it swings lower, bounces back up, swings lower, bounces back up, lower highs, lower lows. So look how the MACD interplays with the downtrend. So what you've got here is the MACD line crosses below 0. So that is a trend indication when the MACD line crosses below 0. And that gives you the filter, perhaps, to take only short trades, or maybe to long trades to take only from extreme situations. So the MACD follows the price lower. And what you've got here is this MACD histogram, where you've got the difference between the MACD line and the signal line. In other words, these two lines. So when the MACD is above or below the signal line by a certain level, that gives you a kind of extreme overbought, oversold situation, even in a downtrend. So in a trending phase, what you've got here, in this case, what you've got is the MACD histogram, the difference between the signal line and the MACD. They tend to top out and base out at similar levels, as you can see here. So as the market swings lower and we go towards one of these levels with the blue line using the visual inspection, that gives you an idea that perhaps we're ready for a snapback and maybe a counter trend situation. As the market snaps back to the upside, where do we look to sell it? Well, we're looking for MACD to stay below the 0 line, which it does because it's a downtrend, but the MACD histogram to top out around these, in this case, around plus 243, 240, so 24 pips to the upside, where we get this difference, and we look to sell it for a move lower. Okay, this is Euro Yen, a similar kind of situation to the last example. The market is trending lower, although this one is perhaps in a more of a shallower trend to the downside. So we get the crossing of the MACD below the signal line, below the 0 line, which tells you that the trend is pretty much down. And as we get these bounces, where do we look to sell this market? When the MACD histogram gets to the level that we see where where it typically tops out, in this case plus 705 pips on this one. So we get the bounce up. We're looking to set, once we get in this overbought region, we're looking for this kind of topping out situation to take a stab at the short side in the direction of the trend. And you can see I've ringed a lot of these swing highs within the downtrend as they coincide with this MACD histogram hitting the overbought level. This one's Aussie dollar on a daily chart. What we have here again is a kind of a shallow downtrend, but very big or decent counter trend movements within this downtrend. So what we've got here is we've got a lot of whipsaws actually for the MACD crossing the zero line. So the MACD, using the MACD crossing the zero line wasn't a great idea during this phase, because it was quite a choppy phase. But what we had was the histogram topping out roughly around the same level here for the bounces. So you can see a few of these topping out situations here. So the market bounces for several days, tops out, MACD histogram tops out, starts to go lower. An indication one could take a stab at the short side. On the way down, what we've got is the MACD histogram here basing out around the same kind of level here. And what I've done here is I've drawn a line for the MACD line itself. So what we've got here is the MACD line basing out around the minus 50 level here during this trending situation. So we can use the MACD line itself, and we can use the MACD signal line, or the difference between the MACD and the signal line, which is the histogram, to give us indications of where to look to buy and to sell. Okay, so now I'm going to talk about an indicator which is very, very different from the ones we've looked at so far. This one is more concerned with market volatility rather than momentum, and it's called the average true range. So this indicator again was developed by Wells Wilder, and it's a measure of, as I say, the market's volatility. Now, the true range, it uses the true range, which is a calculation I'll talk about, and it goes back over a look back period to give you a reading on the volatility of the market. So the true range is the highest of the high or the previous close minus the low or the previous close. So it's simply a way of saying what was the previous day's range and is it above or below the previous bar's close. So it's kind of it gets to be significant when you're dealing with markets which can gap above or below the previous day's high or low. So if we're talking about futures and stocks in particular. Foreign exchange, perhaps, when we're talking about a Friday to Sunday night, Monday morning gap, but that's quite rare. So standard period for ATR is 14 periods. Also, the 20-day or 20-period ATR is quite common. I use the 20-day average true range for a lot of my work. So the theory is that as market ranges, daily ranges, for example, expand, so the noise level expands. So what do I mean by noise level? So if the market typically moves 50 pips on a daily range, and that daily range starts to increase, then the counter trend movements will typically be larger. So if you're using a 50 pip stop and the average true range is 200 pips, then the 50 pip stop is not a very large number in terms of pips. It's only 25% of the average true range. But if the average true range is set at 50 pips, then obviously a 50 pip movement is highly significant, because we're talking about the market moving at least one average true range. So it's quite an important thing to quite an important gauge to use when calculating the size of your stops, because obviously when volatility is high, you don't want to be using smaller stops in terms of pips, and I'll come to that a bit later. So when ATR rises, what we should be doing is increasing the stop size in terms of pips, but to reduce the dollar risk of a trade, as we increase the stop size, we need to reduce the trade size. So what we're doing is when the volatility rises, we're increasing the size of our stop, but because we're taking on more risk using a wider stop, we need to cut down our trade sizes. And this way, we'll keep our dollar risk constant, but we are avoiding the whipsaw that we see based on the noise. So just to show you a graphical representation of the true range, what do I mean? So in this case, the range in this case, let's assume these are daily bars. In this case, the range of yesterday is the high minus the low, but the true range, because the high of yesterday was below the low of the day before it, there's a difference between this bar and the previous day. So what we do is we take the close of this bar, and the highest one becomes the high of the true range, and the lowest one, which is the low, that becomes the low of the true range. So the true range you can see here is actually bigger than the previous daily range, and that's what goes into the calculation of average true range. Similarly here, because the low for the previous day was above the close of the day before. Sorry, I mentioned the low of the day before. You're comparing the low of the bar here to the close of the day before, not the high. So because the low of this bar was above the close of the bar before it, we take the lowest value for the true range. So it's the close of the bar before the bar we're looking at. So the highest point of the true range is the high of the previous bar, and the low of the true range is the lowest of the low or the previous close. So again, in this case, the previous close was lower than the low. So the low for the true range is the previous close. So what we're doing is we're comparing the price to the average true range to get a gauge on volatility, because volatility, as I've mentioned, can be quite important when ascertaining how big your stop should be. Because obviously, if we're using a 50 pip stop and the average true range is say 200 pips, we're going to be taken out on random noise. We want our stop losses to be significant when we're trading. So just to show you a couple of years of euro dollar price action compared to its 20-day average true range, which is one which I use myself. So what we've got here, you can see that over this period, 2018-2019, volatility was in a trending lower phase. So the market was trending lower, but that's not necessarily significant. The direction of the move, the fact that the daily ranges for euro dollar were getting smaller and smaller. So the average daily range, or the average true range for euro dollar, was trending lower. So in other words, if you're trading euro dollar, let's say you're a day trader, you want to use smaller and smaller stop losses when you're trading, when the volatility is falling. Okay, so what we had here was in 2019, late 2019, euro dollar plumbed the lowest levels of volatility that we've seen for a number of years. So that made life a little bit difficult for breakout traders and systematic traders that use breakout methodologies. In fact, the opportunities that existed during a low volatility environment, not good for many of the popular systems. But then we got the explosion in volatility in Q1, and you can see there euro dollar started to see big gyrations in price, in trend, not so much in trend, but more kind of in two-way action. And the average daily range expanded very, very sharply. So you saw a contraction in volatility, followed by an increase in volatility, which obviously gave you a bit of an indication as to what one should do with stop losses. Okay, and this goes back to this is cable going back to the previous financial crisis, 2008, 2009. So what we had here with cable was that for a good period of time, a good 2 or 3 years, the average true range for cable was 100 pips to 200 pips. So that was kind of a good barometer as to how you should manage your risk. But then once we got into the crisis starting to take off, we saw the average true range explode to the upside, and we saw the average daily range shoot up to around 500 pips. So quite extreme levels of volatility there for cable. Eventually, the thing came back and settled down to more normal levels, as it typically does. So just to talk again about this position size, how one could use ATR for position size. So let's say that typically you're using a 50 pip stop on a one lot trade to control your risk. So a 50 pip stop is large enough to avoid the noise if ATR levels are, say, 100 pips and below. But if ATR doubles, as we've seen it can do, that reflects a large increase in volatility. So the noise levels, i.e. the movements that we get from up to down intraday, they're going to be bigger than they previously were. So it would make sense to increase the size of your stop in line with volatility. So what I like to do myself is if volatility increases by if it doubles, then I like to half my position size. And similarly, if volatility halves, I like to double my stop size. So in this case, what we're talking about is the stop size. If the ATR doubles, reflecting a doubling in volatility, then one should double the size of the stop, but half the size of the position. So doubling the size of the stop to reflect the higher volatility, but halving the size of the position to equalize the dollar risk. Okay, so now I'm just going to flip across to MT5 just to show you just a few examples of an oscillator in action on some of the recent price action, and just to give you a little bit of an interpretation based upon how I view the oscillator. Okay, so first things first, let's start with the S&P 500. What I've got is the S&P 500 plotted a daily candlestick chart with some averages plotted above a 14-period RSI. So just visual observation here. What we got. This is the bear market that we saw during the earlier part of the year. You can see the market trending lower highs and lower lows in the price. And then the oscillator got quite extremely oversold here. But then we got this kind of bounce back, lower highs, lower lows, divergence as the market makes lower highs, lower lows. And eventually the market bases out under the oversold level, starts to trend higher. And then we've been in this kind of bull phase for since that point. So then the market is trending higher. It breaks above the overbought region as one would like to see during a typical uptrend. So we're not topping out, struggling at 60 or 70. We're making new highs above 70, and then we start to correct lower in the RSI. And as I said before, when we're in a healthy bullish environment, we're looking for the RSI to base out not below 30, but say between 30 and 40 as a good. Or between 40 and 50 as a good idea for a basing situation. So that was the case here. This consolidation saw RSI base out, in this case 45, and then the market broke up to make new highs. So what have we done recently? We've had a bit of a pullback recently. The market did get very overstretched at this point. We had RSI reading of 82, the highest that we've seen during this bull phase. So healthy correction. We've pulled back into the moving averages as we did back here, and then yesterday a nice bullish, looks like an engulfing candlestick, a nice reversal, and it looks like we're trying to do some sort of basing. This looks like typical basing action within a bullish environment. RSI wise, so we've corrected back. We've gone from overbought back down to this level. The lowest it's been so far is 42. So nice, healthy, bit like before, 45 on the RSI. So a similar kind of momentum kind of pullback. So could well be a good indication that we're ready to start basing out perhaps for another push to new highs. Moving across to euro dollar. So euro dollar, we had this big sideways phase as the market made a very important low. We had a bit of a triangle pattern here, which you can't see the lines there, but eventually it broke to the upside. And then you saw the RSI move with the price above the overbought zone. So nice typical bull market action. And then we get the pullback. Similar kind of thing to the stock market, although it did base out a little bit higher, 52 on the RSI. Nice healthy little triangle pattern here, or a pennant, depending on which way you view it. And then we broke up to new highs for the trend. So we swing high with euro dollar. We break up to a new high, so no divergence at this point. So 81 on the RSI. And then the market does form a little divergence. And then we come back below the overbought region. We're trading at 60 there. Then it swings higher. Then we start to get this kind of more classic divergence that we see at important turning points, like, for example, this one here. So the market made a momentum low there, breaks up, comes back down again, and then does not make a new low for the trend. Makes a low for the trend on the price, but not on the oscillator. So then the market goes into a sideways chop, eventually goes higher. In this case, what we've got is we've got this market pushing to new highs on the oscillator, but we're not, new highs on the price, but we are not getting new highs on the oscillator. So that tells you that we've run out of a little bit of steam, at least in the short term. So we're in a kind of a chop phase like we were back over here. Now, the interpretation, I would say, as the trend indicators are still quite solidly strong, we're still trading between the short moving average and the medium moving average. So still kind of bullish to the upside. We've not had any major pattern breaks to the downside, at least not yet. If we were to break through this low here, then we'd have a kind of a head and shoulders and we break lower. But for the time being, it seems to be very well supported in the moving average zone. So what we've got with the oscillator here is we've come down to 48. So again, we're still not busting into this oversold region as we would expect during a typical bearish phase. So this could well be perhaps a bit of a buying spot here. If we can consolidate here for maybe a day or two and start to go higher, this divergence could well have run its course, and then we start to see a big momentum push to new highs for the trend. So I would say cautiously bullish on this one because the trend is up and the oscillator is starting to base out in the oversold region for a bull market. That's euro dollar. Let's take a look at crude oil. This is West Texas. So what we got with this one is, as with the stock market, the market trended lower, and then we got this massive push to a new low with divergence there, which is the typical overextension signal. So new low for the trend, not a new low for the oscillator. Market starts to base out. Good indication that we might be ready for a turn in trend, which we start to get by the price action. Now the market has been settling above the short and the medium moving average. But then we've got this recent break lower, which looks a little bit worrying in terms of structure for the market. So a little bit different compared to the Dow Jones and the S&P and the euro dollar. So this looks a bit more like perhaps it could be a structural break in the trend, because RSI in this case has gone below 30. We don't expect it to go a whole lot below 30 during an uptrend. And then the market is starting to try and find a bit of support here. So this could be a candidate to look for a counter trend bounce. If this does not make a new high for the trend when the other markets are pushing to new highs, this could be an indication that we're ready to sell for another leg down in crude oil. So a little bit of a divergence between this market and the other two major markets, which it kind of tracked for a fair amount of time. Okay, so that pretty much just that wraps up the kind of overview of a few of the major markets with the trend indicators, the price action, and the oscillator using RSI. Just going to flip back across to the presentation where we go. Stop sharing. We go there. Okay, so that pretty much wraps it up for me. I hope you've gained something from this this presentation. I look forward to seeing you next Thursday when we have another one in the series. So thank you very much for attending, and I look forward to seeing you there.